All right. Okay, good morning, Beverly Hills. Very happy to be here to talk about the asset management outlook. And we have a great panel. So what I'm going to do is I'm going to let them introduce themselves very briefly, and then we're going to jump right in. And we're going to have a pretty wide-ranging discussion. These guys have promised me that they're fired up and ready to go, to disagree a little bit, and keep it lively for you here on a Tuesday morning. I know everybody was out late last night. Emily, I know you were out late last night. Just kidding. So let's start to my right,
Yeah.
David Druley.
Yep. I'm David Druley. I'm CEO and chairman of Cambridge Associates. Cambridge Associates is a global investment management firm that works with pensions, endowments, and foundations and ultra-high net worth clients, and implementing portfolios, total portfolios, in private equity, hedge funds, long-only securities, pretty much the whole spectrum of investments. We've been around 40 years. We've been doing this a long time, and I have to say, and I'll convey this in the panel today, we've seen it all, and we're seeing it again. So we'll talk about that today.
Right. Nobel Gulati, go ahead.
I'm Nobel Gulati at Two Sigma. Two Sigma is a technology company which was founded 16 years ago, and our mission is to find value in the world's data. So we've applied engineering and the scientific approach to financial markets, and in the field of investment management, we manage over $40 billion in assets.
David Hunt.
I'm David Hunt. I'm the president and CEO of PGIM, which is the trillion-dollar asset manager of Prudential Financial. We manage assets across a wide range of asset classes, primarily for the world's largest and most sophisticated investors.
Michelle.
My name is Michelle McCloskey. I'm the president of Man Americas. We are not a trillion-dollar firm, but we are an $83 billion alternative asset management firm covering both quantitative and discretionary strategies for a very diverse and global client base.
Okay, and finally, Ron Mock.
My name is Ron Mock, CEO of Ontario Teachers Pension Plan. We're out of Toronto. We manage the retirement income for 300,000 teachers in the province of Ontario. Up in Canada, we do operate a global platform. We have about $175 billion under management, and it's a unique pension plan that manages pension assets in a very different way for generations of teachers into the future.
Great. Okay, so just to give you a sense of what we're going to talk about, as I said, it's going to be pretty wide-ranging. We want to talk about everything from fees to China to Trump. We're going to pick up the thread that I think has been through a lot of the discussions so far at this conference about active versus passive. We're going to talk about artificial intelligence. We're going to talk about the geopolitics that are maybe affecting the asset management business, and we're going to talk a little bit about talent. But I wanted to start with a question for everyone, and I'll pick on a few people to start, which is, we seem to be in this, and you'll hear me use the term existential debate, because I feel like there's a lot of existential debate in asset management right now, but specifically in alternatives. And Nobel, I'm going to start with you and say, there is no such thing as alternative assets anymore. Discuss.
Okay. Well, I think you're right. These classifications
That's why I picked him.
You see? Good. We rehearsed. I think these classifications aren't helpful. I think that the investment management industry, the consultants, the sell side to some extent has created these categories, these classifications, often around asset classes and geographies and so on and so forth, that have resulted in tens of thousands of investment options that are somewhat overwhelming across dozens of seemingly arbitrary categories. And no one is really looking at it from the investor's perspective, whether it's an institutional investor or a retail investor. At the end of the day, it's not that complicated. They have a fairly small number of goals, investment outcomes that they're trying to achieve. There's a fairly small number of risks that they're trying to avoid. And there's a fairly small number of risks that they are willing to take and they want to get compensated for, effectively compensated premium. So we think that the whole classification is sort of wrong and will evolve because it'll make for much more efficiency that will ultimately accrue to the investors.
So Dave, you're nodding your head. You seem to agree, but what are the implications of this for your business? And what do we do about this?
So, well, I agree. I don't know that there's implications for our business, but I agree they're really vehicle types that we've lumped together, call them asset classes, And the reality is, in aggregate, some of these supposed asset classes are not going to do well by the investor. For instance, you have 10,000 hedge funds out there. There's probably 100 to 200, in our opinion, that merit institutional capital. So when people look around and say, wow, we've had a bad experience with hedge funds as an asset class, of course they have. In aggregate, you're going to get mediocre returns. So I agree. What we should do is look at the underlying exposures, what we're trying to achieve, how much alpha and value add do we get out of that, and then structure the fees that well align the manager and the strategy with our client's capital.
So hold on, I want to make sure I understood what you said. You think there are only 100 or 200 good hedge funds out there out of 10,000?
Yeah, that's about right.
Michelle?
Well, hopefully we're on that list. That's a pretty narrow list. We do run 3 distinct different hedge fund strategies, and we have a very large multi-manager business that goes and helps our clients invest in hedge fund strategies. But I would agree that the universe itself probably got very muddled over time. There were probably very weak or middle-of-the-road type managers that were able to function in years past that are gradually being weeded out of that universe. Since the crisis, it has become, and Dodd-Frank and the regulation and what have you, it has become more difficult, more expensive to run an institutional quality hedge fund. And so only those folks that can kind of pick up that glove and take that challenge and make their firms institutional and offer continued return and the alpha that they promise. I think, unless you are creating return, you're going to be weeded out, to your point. If there's 11,000 out there and in your opinion there's only 200, we probably have some more attrition coming.
So I don't want to get too far away from alternative assets broadly, but let's stick with hedge funds for a second there, because this is awesome. David Hunt, are there, a year from now, or maybe even 5 years from now, are there net fewer hedge funds out there? Or is this just many will go out of business, but many more will come into existence? Where do we end up, call it 5 years from now?
So I'm going to go back to your original question about what does alternatives, even hedge funds, means. Let's remember what alternatives were supposed to do, and take this from a client point of view. Alternatives were supposed to add diversification because they weren't correlated with other asset classes. That was where this all started. And we've looked very closely at client portfolios and where we've seen return, what it's cost, and then what risk diversification it actually put into the portfolio. And you've got to understand all 3 of those dimensions. There's way too much focus on just first return and then maybe a little bit cost, but all 3 of them are important. What we found going back over 2 cycles was that actually a lot of alternatives did not add value. Many of them did. But how they did it was often through risk diversification, not necessarily through return. So we found private equity was actually very good. We found that real estate was pretty non-correlated. And we found the majority of hedge funds, with the exception of relative value, actually not only was it a return problem, but actually it didn't add to risk diversification. And that's the biggest issue. So to come back to your question, if hedge funds can't add both return and diversification, we will see fewer of them. And that's competition, and investors will be better for it.
So Ron, David just mentioned a couple areas where I know you have a lot of experience, real assets and private equity. David Bonderman yesterday, I believe, said, and we're going to get into the discussion about active and passive, private equity is the best active strategy out there. Not surprisingly, coming from David Bonderman. But what is your take on what's been discussed so far in terms of where those real returns are coming from? Are you seeing them in private equity and in real assets?
Yeah, first of all, the nomenclature of alternatives, hedge funds, I'm not sure what all of that really means. Yeah. What we end up looking for is a value proposition, a sustainable value proposition. And we look internally or externally, if we're going to dollar to invest, we're going to put it where we can get correlation benefits and great risk-adjusted returns. And whether that comes in real estate or infrastructure or private equity, in our real estate and in our private equity world, we also break that down into geographic diversification and specialization. We break it down into sector specialization. But we're always on the hunt for a way that we can get great diversification, and value added. If the value proposition is not there in time, that's going to fall by the wayside. And so I think from our perspective, we have hedge funds. We probably have about 10 billion in hedge funds today. We've been in them since 1995, and it's absolutely true. A few select managers, by few I say 40, 45, max, and we focus and concentrate. Smart people, whether they come out of private equity or real estate or the so-called hedge fund world, we're looking for those, and it's the long-term sustainability of that value proposition that we're on the hunt for. So the nomenclature becomes rather irrelevant to us.
So I agree. So let me, if I
Yeah,
can,
please.
I agree with what's been said by David and Ron. I think the nomenclature is clearly confusing. I think at the end of the day, we talk about hedge funds, but really we can generalize this a little more. It's really all active management.
Yeah.
Yeah.
And I think that's the more relevant. And active management is meant to be there for the purpose of seeking alpha. Alpha is really, really hard if you define it correctly. There's just not enough of it in the world. It's really a scarce and precious thing if you can find. And by the way, even if you find it, it's not generally sufficient to meet the objectives of most institutional investors at that scale. So if you think of the sources of returns coming from really three different forms. Most people think alpha and beta, and that generally is correct, but I think that misses a big part of it. We think that there are really three layers. Think of the world as a pyramid. At the top of it is really pure, uncorrelated, risk-adjusted alpha, the real thing. Okay? There's not enough of it in the world. If you find it, you should sprinkle it on any portfolio. It's a wonderful thing. At the base of it, we have effectively beta. I think everyone understands what that is. That should be nearly free. And that game is being won already by effectively, it's going to be a winner-takes-all business. It's going to accrue to those players who have the brand and have the scale and have the efficiency, and we know what that is. That layer in between is where things get confusing, because that is largely being currently supplied by today active management, be it hedge funds or be it long-only traditional managers. They are effectively, but what they are providing through those tens of thousands of offerings is some sort of a mixture of maybe a little bit of alpha, but not often there, as many of my panelists are commentating, a lot of risk premia oftentimes, and even some amount of beta, which really should be free. So if you're able to disaggregate, if we put analytics and technology in the hands of investors to be able to look at their portfolio, look at any offering, any stock or any fund or any portfolio through that lens, and be able to say, what am I really getting? Am I getting real alpha? Am I really getting risk premia? Or am I getting beta? And in what proportions? I think that this is going to shift the balance of power towards the asset allocator.
It's even more, I agree with that. It's even more interesting than that, right? It's scarce and it's a zero-sum game. So it's very competitive. And the fact that we have a dialogue going on right now that says, wow, active management hasn't worked. We're going passive. In aggregate, active management's not going to work. And we look at the data and you think about what people call alts is really strategies with more degrees of freedom, whether it's to take illiquidity or take positions that are off benchmark. So when we look at the difference between 5th percentile performance and 50th percentile performance or medium performance in a group of long-only managers, the spread's 200. Absolute return, 500. Long short, 600. Private equity, 2,000 basis points. Venture, 3,000 basis points. So as you go down the path of pursuing active management, what this really means is you have to find, either internally or externally, the skill and talent to identify the managers that can execute and grab that alpha, right? And the fact that people are disappointed, it's not a surprise. So if you don't know if you have the skill or talent, or you're not committed to going out and finding it, you probably should go passive. The good news to people that are that go active, I love it when I hear that the 50% of the US market is owned by passive funds. That's dumb money. That means that you'll get fundamental distortions in valuation, and it'll be actually a more robust landscape for good active managers. And I don't mean to say it's dumb money, people shouldn't do it, but it's blindly buying components of an index or an ETF or whatnot, not based on generally fundamental concepts.
I would make the point, the dumb money part, I'm not so sure that's necessarily dumb. We definitely have to get exposure to beta for sure. But on this alpha and the construct that you just went through, this alpha is always, in my view, moving. Where alpha came from 20 years ago, where it's coming from today, where it'll be coming from 10 years from now, it's always shifting. And so when I think of what alpha was available in hedge funds, for example, a decade or two ago, it's completely different than it is today. Alpha was uncovered in algorithmic trading 8, 9, 10 years ago. Where we're seeing lots and lots of value creation is in, for example, you find it in different places. This is why you have to be on the hunt for it. For example, in our real estate portfolio, we own a real estate company with 1,500 people in it. And they actually buy the land, build the buildings, manage where Apple goes and Zara goes inside. The value creation is coming out of that process. In private equity, it's not buying companies cheap any longer. It's actually figuring out when you do buy them, the way in which you will change management and their process and or help them grow their EBITDA. And that requires a whole new level of talent again. So where you find it is really always, always changing. And once a ton of people have found it, it ultimately collapses, and you got to go looking somewhere else.
Or it becomes a beta, right?
It becomes, I'm sorry, what?
Actually, I think it's a
It
mixture.
becomes beta.
Thank you.
I think the point that you made, David, the dispersion that exists in all of these different categories, if you want to use that, and to combine that with what Ron said, which is that there is alpha, whether it's shoe leather alpha, or whether it's structuring alpha, or whether it's sourcing, or it's business process improvement. Those things are true, but they often get conflated with, and it's hard to tell the difference, how much of the return is attributable to effectively locking up your money, illiquidity premium, how much of your risk is, how much are you getting compensated for taking effectively emerging market risk, or how much are you taking, you're compensated for various factors if you're taking duration risk in some cases, or how much of it is truly the alpha, the shoe leather, or the business process improvement. It doesn't matter whether you're dealing with real estate or you're dealing with liquid markets.
So you wanted some disagreement on the panel, so
Yeah.
let me offer a different point of view.
Get in there,
This,
come on.
this debate about active versus passive not only is misframed, but it's actually been way overdone. So the entire construct that Nobel went through, which I agree with in theory, applies to really a very small proportion of the assets that one can manage. Where Ron just went to for real estate, or a lot of the money that we manage in privates, or other types of fixed income, which are very difficult to separate out alpha from beta. You don't have investable passive classes in these things. And so active has actually way outperformed what you could invest in, even in things like fixed income. So I take us, for example. We're a $1 trillion manager. We're all active. We've had inflows for 14 consecutive years. And part of that is our business mix, and part of it's been our performance. But people are way too focused on the US equity market, where this dynamic is playing out, and somehow trying to stretch this into asset management. It's not. It's a small group of assets where you can do the disaggregation that Nobel was talking about. But let's not let that get out of proportion to everything else.
I absolutely agree with that. I think the argument has been very pedantic. It's been very, very narrow. You've heard a lot about just passive index buying, and then what does the active long-only manager actually add? Well, unfortunately, they're adding occasionally a load of fees and not very much value. So, the argument, I think, has been kind of isolated to a very narrow space, and I think the points that are being made here are very accurate. This is a big, broad topic that we're discussing, and essentially what everybody's looking for is a way to generate efficient return,
Right.
one way or the other, and protection and diversity and the ability to grow over time in their asset base.
So Michelle, I wanted to stick with you for 1 second on that, because clearly implicit in all this is what are you paying for what you're ultimately getting, right? So what are we seeing in terms of fees? What do these guys need to know about where fees are going
Right.
in the next 3 to 5 years, do you think?
So I think there's a couple of things to say about fees overall. First of all, it's a much more energetic topic than it ever used to be in the past. Fees are openly discussed, they're negotiated, they're They fit whatever it is that the investor is trying to do. Whereas before, particularly on the hedge fund side, it really wasn't even much of a discussion. I think we've touched on a couple of different things. So number one, breaking down the exposure and the per unit risk that you're taking and what you expect in return. You should be paying a fee that represents the risk and the talent and the skill and the factor exposure, et cetera, that you're taking. If you are somebody at the top end of Nobel's pyramid and you are actually producing consistent alpha and diversification for your client, you can probably still charge reasonably high fees. If you're somewhere in the middle where you're bringing in that risk parity exposure, where you're bringing in well-known aspects in the market and it's something that can be executed and identified fairly easily, you shouldn't be charging hedge fund fees. You should be charging something somewhere in the middle between passive and hedge fund fees. And I think that the industry is breaking down and you're seeing a range of fees more and also more creativity in the way that the managers are willing to work with the different investors in terms of, for the hedge fund side again, hurdles, clawbacks, all kinds of things that you just didn't see 10 years ago are now openly discussed and worked into your relationships.
I think overall the fees, if you look at it in aggregate, the fees are going to come down at the industry because there is more efficiency and there is more power that's being placed in the hands of the asset owners. They have more clarity. They can now see what they're getting and what they should be paying for. They are able to keep their managers honest and accountable. And I think what that's going to translate into is whether it's 50 or 100 or 200 or whatever number of managers that are able to generate consistently real alpha, I think those fees might actually go up.
Yeah.
Because there's just going to be more demand, more.
I would completely agree with that. I mean, I'm always surprised at this discussion on fees and revenue pressure. If I asked you, do you think the top 1,000 institutions around the world pay more or less to have their money managed now than they did a decade ago, what would you say?
I would say they pay less.
Yeah.
No. They pay more.
Damn it.
And the reason they pay more is because there's been a big shift in their mix of assets.
Yeah.
They pay less for a lot of the stuff that they can buy on cheap beta, but they pay a lot more for some of the kinds of asset classes that Ron was talking about and some of the pure assets. So the actual shift in mix is at least making up for the fact that you've got real pressure on some of the fees, which are effectively beta or leverage beta that are coming down. And the trick for the managers is to make sure that you're offering that alpha that you can charge for at least as fast a pace as you're getting your fees driven down. But it is a myth that fees overall are dropping.
Can I unpack that just for 1 second, though? When you say fees are down or up, are they up in dollar terms or are they up in, for example, basis point terms? Because as assets grow, ultimately the dollars rolling in on the fees is going up, but not a whole heck of a lot has been changing. Is it just through asset growth? In other words, is it a basis point amount or is it a dollar amount that has gone up? Because if it's dollars, it might be just AUM growing.
Basis points are slightly up and dollars are up probably about 6%.
Fair bit, yeah.
This is the dichotomy of what's going on, though, is people are thinking about liquid assets moving passive, and then they're going as active as you can get in some of the private investments, whether it's real estate or private equity or venture. And again, you go back to the dispersion numbers I gave you. I mean, that's a reflection of how important active management is in those asset classes. So I hope that as people are thinking about taking this move towards active, which they did 10 or 15 years ago on hedge funds, and I'm not sure people really understood how much talent and skill you needed to identify the 100 or 50 managers, Ron, whatever we want to agree to, that it took to identify those. I hope that the lesson's been learned today that if you're going to go down this active path, you need to find the resources that can identify the managers that are going to outperform. If you don't, we're going to be here a decade from now having the same discussion about how everyone's disappointed with their pursuit of active strategies in the private sphere.
Yeah.
I think there is going to be, so I agree, this debate is overdone, the active versus passive. What we've witnessed for the last 4 decades is a massive shift from active to passive where passive has been defined as indexing. I think what we're about to see over the next decade is a tremendous shift in the field of active itself, because not all active management is going to result in alpha. Some of this active management is going to result in honest risk premium. And I think that is going to command lesser fees. There are few pure expressions of that available today. I think there is an opportunity for people to create and honestly say, look, here's a source of returns. It's a perfectly valid and justified source of returns. It's not alpha. It is a form of risk premia that is available in building blocks of various kinds and colors. And that is actually going to give an alternative to asset owners to buy. And I make the distinction because it's not passive in that it's not indexed. It still requires active management and optimization and trading and so on and so forth. So all those skills will matter. But quite explicitly, people aren't trying to seek or pretend that they are delivering alpha there. They are really delivering risk premium.
But just to add to that point, though, too, when you're talking about that kind of risk premia and extracting it and doing it efficiently, the business systems and the execution of that are all very important, too. So it's different than indexing. It's different than truly passive investing. It should be paid a slightly higher fee.
Slightly higher.
Because it's more difficult to execute.
Absolutely.
And do it correctly.
So I want to spend a little bit of time on talent because I feel like that is implicit in a lot of where this discussion has gone. And Ron, I want to start with you because the Canadians, broadly speaking, and specifically your pension have been singled out over time, you guys, CPP, Case Depot, and others, in part because you have been able to go direct more and largely because of your ability to attract and candidly compensate a very robust investor class of sorts inside your shops. Tell us about sort of how that stands now and where you see it going and whether you see other people around the world, for lack of a better term, trying to be more Canadian.
That's a good thing, actually, as a proud Canadian. First of all, the top 8 plans in Canada manage about 1.1 trillion, and they do it on a model like Teachers. Teachers came out early in the mid-90s and opened up this model. It was a whole new governance structure, complete new governance structure, run it like a business, independent board members have to be from the financial community. A lot of them are CEOs from banks and others. Different structure completely. And what we're seeing today is that other large pools of capital elsewhere in the world, whether they're coming out of Asia or Singapore or the Middle East, you think of Audi and Qataris and others, they are moving more and have moved very rapidly in the direction of the same kind of model. Run it like a business, invest in lots of privates, and pull in the talent that is capable of driving value creation. I think a lot of the US plans, and we're starting to see more of the UK plans heading in this direction as well. And there's some secret ingredients to actually make this thing work. You can't just go there if you don't have all of it. But definitely the move is there. And I think this is where we have to be very aware that this move to real estate, infrastructure, private equity, the amount of money that has moved into this area, illiquids, it's not publicly traded markets or trading securities. This is about having the talent to go in and buy companies, change them around, manage infrastructure, manage airports. This is a whole new definition for talent. Every one of the ones that I just mentioned, the Canadian ones, the Singaporean ones, and else, they're all doing a very, very similar thing because that's where value has gone. The unfortunate news to that is it's bidding up infrastructure prices, private equity prices, and others to a level that is fairly high right now. As a consequence, you're now left with, yikes, this is what, this was a great area to play in for quite some time. All of a sudden now we're seeing things get compressed fairly substantially. So where do we continue to hunt as we roll forward? But it is a model that is being utilized or is being brought forward outside of the Canadian purview, for sure.
And just let me highlight, because I'm a big fan of what the Canadians have done, and I think there's a lot to learn from it. And in the U.S., where we have also seen this shift to illiquids, and people are discovering the benefits of the duration, the non-correlation that you get with that. What people have to understand is that there is a whole new talent set that is required either to manage that yourself or to manage people like us who are managing it for you. It's not a generic skill set. It's actually very specific. And it's really important that pension funds staff up in advance before they move into some of these with the kind of skills that can help them oversee it. And as I look out, particularly in the public fund world in the US, I see that as a big challenge.
Yeah, I mean, it seems to me, Michelle, that there are some structural impediments, just thinking domestically here, that we've seen for years and continue to see for the U.S. plans, especially the public plans, to really get into this in a meaningful way, or certainly to the extent that some of the Canadian ones have.
Yeah, I think from what I've seen, the U.S. plans are very different. There's a wide array of the way that they're run and managed and the talent that they hire. Some teams seem to work with a little bit more of a budget and a little bit more autonomy, but unfortunately many of them are very restricted in the number of folks that they can hire and the types of quantitative tools and things that they have to work with. So, you know, I know Nobel and I were talking about this earlier, both of our firms, and I'm sure across the board, we try to partner up with those plans to try to help them to the extent possible. But right now, you know, we just don't see sometimes the depth of that knowledge on some of those investment teams. Hopefully that will change over time.
Do you think it'll change?
I think it is changing. I mean, clearly, I think that you know, the Canadians are perhaps have set the bar. They are ahead of the curve, thanks to the governance and all the other things that Ron mentioned, and that's true for some of the other sovereigns around the world. But I think the trend universally is in that direction. I think we are seeing much greater talent, much greater investment, much more analytical talent. Amongst our allocators. So investors are becoming much savvier. And I think with the help of technology, which they are embracing, I think that is going to be the leveler. I think that even if they cannot have a team of the size that Ron has or that a big sovereign has, I think that technology will allow them to be much more effective and reclaim what we've come to term organizational alpha.
I'm interested in the idea that you had very specific targets for the type of board members that you wanted for your efforts. And, you know, I've also seen a difference in the types of folks that are on those governing boards. Some of them are, you know, experienced and seasoned investment professionals across the different investment landscape. Others are not, right? And so I think it's important to work not only with the investment staff, but also in help in educating the boards of the public plans as well.
Well, and in some ways, it's something that the endowments figured out. Many of the big U.S. endowments especially figured out a while ago that if there is a wealthy alumnus or alumni who can, you know, come in, who's been successful in investment, you know, Notre Dame did that. I mean, there are a number of examples where they've brought people into the board who have been successful hedge fund, private equity, real estate investors to help guide that, not on a staff level, but on a board level.
It highlights, too, that they're not only bringing their knowledge and, you know, putting them in place because their contribution to the entity, they bring a network. And this is one of the things I think about. 30 years ago, you spent a lot of time, managers did, we all spent a lot of time trying to get information edges. And you can still do it, but it's very difficult. And the reality is, information is freely and readily available. It's more figuring out how do you sort and synthesize the information, and then the power of networks, whether you're doing what Ron's doing, going out looking for direct deals, or the power of networks and trying to identify GPs and accessing those GPs is extremely important today. So I think that the whole industry has changed in my 25 plus years.
That governance issue, back to the board, I can't say enough about it. It is no politics. That's the first point. While we manage union retirement funds, the reality is if our teachers are having a debate and they're arguing with somebody over a contract, that'll have nothing to do with us. We're not in the middle of it. They don't trade increase in salary with pension benefits down the road. They run it like a business completely. If the government's involved, they have the best independent directors that they can put on the board. Why is this important? Because if we're going to run it like a business, if we're going to run it like an investment company, we have to have that independence to do the right thing. So between the governance and the board as one, the kind of talent that we have to hire now, we're finding more and more, for example, in infrastructure, we have to have staff on board that we have 5 airports in Europe. And in those 5 airports, or managing those 5 airports, or sitting on the boards of those airports, we have to hire completely different talent than the PhD in risk management that we might have hired 10 years ago to look at some algorithmic trading process. So the kind of talent, the operating talent, the engineering talent for this is really a shifting dynamic for someone like us. This is the extent to which we now go to in order to find that alpha, to find that value creation. And we just see it ramping up further and further as we go along, because it has yielded benefits. Our return profile coming out of our privates world, which is about 55% of our entire portfolio, that has been a substantial contributor to the return profile that we've had since inception, which is not too bad.
And is your sense, Nobel, that the returns that can be gained from that sort of approach are offset, the cost to get those returns is offset by technology? I mean, is the technology bringing the cost down enough that this is an affordable approach? Because what Ron is describing is not a cheap way to invest. If you're paying up for talent, if you're hiring bigger teams, how much can technology offset that?
Well, so I think what we should distinguish, what Ron is describing, and I think he said himself that he's effectively operating like a manager.
Yeah.
So the type of talent that he is seeking in that regard is the type of talent typically an investment manager would be hiring. He just happens to be doing it directly.
Yeah.
And saving a layer of fees, but he has the cost of an internal team. I think most asset owners aren't going to follow that path. Most asset owners won't have the resources to be able to do that. They will effectively hire external managers to go seek one of those sources of returns that we discussed. I think where technology will level the playing field is that those asset owners today spend an inordinate amount of time on picking managers and reporting on them and doing things of that sort that aren't actually the main driver of their returns. The main driver of people's portfolios and returns is in fact doing the few most important things right, governance and strategic asset allocation. And yet they spend a very, very small portion of their time on that because they're so busy trying to identify managers and select managers and report on them and diligence them and so on and so forth. And I think this is where technology can shift the balance.
Yeah.
But just before we leave the talent point, because I think the points Ron made around the way he thinks about the kinds of people, you have to run this like a business in the sense that compensation is viewed as an investment in gaining that alpha. And far too many of the large, particularly public pension plans, are under enormous pressure, which they view compensation as an expense.
Right.
And they're under a lot of pressure and public scrutiny for that. And that just means that they're having to squeeze down and down in terms of talent, which limits their ability to do the kind of things that Ron was saying. So I'd actually argue in this country we're headed in slightly the other direction at the moment, and we need a real rethink of that talent model and what we have to pay for it if we're going to do the kinds of investments in illiquids that I think should be made.
But that would seem to be harder and harder even politically right now, given the underfunding sort of.
And that's the conundrum,
problem,
because of course it's never more important to seek out that alpha in order to begin to close some of that gap. But if your solution to that is to simply squeeze costs, you're pretty clear you're headed down the spiral, not up it.
Right.
I mean, the other issue is you're paying the money today, but on things that Ron's talking about or the private investments we like to make or whatnot, you're getting paid back in 5, 10, 15 years. So everyone sees the expense today when it is an investment, but they look at it as an expense today and don't see
I
the
can't get my finance guys to recognize that it's an investment, but
the
I'm working
finance
on
guys look at everything as a cost.
So one of the things that, again, is implicit in some of the things we're talking about is the shifting nature of where the money is coming from, looking at it very simplistically. I'm a journalist, that's what I do. But one of the things we've certainly seen, and I wonder what you guys think will happen going forward, is the U.S. pensions, especially when you think about alternatives. I know we're not using that word anymore, but I don't know a better one yet.
We banned that word.
It's all right. But obviously, the U.S. pensions were a big contributor to that. Sovereigns have come on to be a big player. Endowments are still there. But I want to talk a little bit about, and especially globally, the role that family offices are playing as a source of capital. And Druley, you and I were talking about this, and I think especially when you think about not just the Middle East, which has been apparent to a lot of people, but Asia and especially China. I mean, what are the implications of that as a source of capital?
I mean, there's significant implications, and we're starting to see. I just got back from a trip through Asia, spent significant time in Beijing and Hong Kong, visiting with various parties, and Ron and I were talking about this as well. You're starting to see a movement there, the formation of family offices that look more like the family office that you've traditionally seen in the US or Europe. And they're starting to they're looking that way. So the operators or the entrepreneurs are starting to think about what happens when I don't have all my money in the entity that I created. And we're seeing family offices come up out of nowhere, basically, with $1 billion, $2 billion, $3 billion in assets. And I think they are going to look more like family offices that you've traditionally seen created in the US and Europe. And it's going to drive a lot of money into the things that we're all talking about here today. So I think there's probably in the neighborhood of hundreds and hundreds of billions of dollars that are going to be deployed in strategies that we're all looking at. So in some ways, it's going to make it more competitive. It's going to give Ron some new partners to think about direct investing with that have specific expertise. But it's going to be a flood of capital. And the other thing I would say is, if you just think about you combine that with institutionally, just the large institutions I spoke with over in Asia and Japan and whatnot, there's trillions of dollars looking for a home and risk assets from real estate all the way up the risk curve.
And it feels like the demographics of this money is different too. Is that right, Ron?
Totally. We have offices in London and Hong Kong. As a matter of fact, I'm in Beijing and Hong Kong next week, meeting with our partners. I just want to unpack something here a little bit. We talked about teachers' governance, we talked about internal talent, and we do a lot of internal stuff, and that's true. But we could not exist and be as effective as Teachers tries to be if it was not for our global partners. We have to build out a whole ecosystem, because the reality is we can't be all things and in all places with all specializations. If we're going to buy something in Brazil or Chile, or we're doing something in Singapore, we need partners. We need local partners. They either come in the form of GPs in private equity, other private equity, infrastructure investors. We need to have these partnerships, and building out this ecosystem of partnerships globally has also, in the last 7 to 10 years, become really, really important for us. Because if we're going to get global returns and get good global returns, good risk-adjusted returns, and the correlation benefits out of all of this, that partnership system is becoming key. And it's true probably if we want to go deep into AI or technology or machine learning, we're not going to build that. We're not going to build that internally, just like we're going to partner with people who have different origination channels than we actually have. Origination channels, an opportunity to see deals coming across the bow is critically important.
So you're talking about the operating expertise. One thing this is going to have an effect on, though, is these family offices will compete for the talent that are in the offices here. So they need people that are good at manager selection. They need people that are good at strategy selection and understanding where to deploy capital and how to be effective. And so you're going to see a real pull on the talent in the industry on that way as well. So Ron's tapping into the expertise that they have on the ground, but those of us that sit on the other side of the table and execute differently are going to be competing for the same talent as these family offices.
It also seems that generation of wealth is more comfortable with technology, more globally minded. I mean, do you see that, Noah? And how does that play through?
I think that's a very good point. The generational shift is considerable, and that makes a big difference. The adoption of technology, and it's actually just a way of thinking. Technology is many things. It's really an algorithmic way of thinking is much more prevalent in the next generation.
Because one of the things that is sort of embedded in what you're saying, David, and you as well, Nobel, is this notion that I feel like in the US and Europe especially, we think about family offices as like old rich dude trying to figure out what he's going to do with all the money that
Yeah.
he made, and his good-for-nothing children aren't going to be running the business anymore. So how does he, sort of figure out how to invest his money? But in a lot of parts of the world, we're dealing with 30, 40-year-old billionaires who have a long way
Yeah.
to go, may keep operating their companies, and are thinking about investing in a completely different way.
And this is right. I mean, where you see some of these family offices being created is people get into their 40s. In their 30s, they're not really contemplating what happens when they're not around, and the second generation that's not really shouldn't run the company and keep the money is the one that has control. But there is a different horizon. The other thing I would say about that, and it's true outside the U.S., but it's definitely true in the U.S., is this generation of wealth creators is more technology savvy and whatnot, is impact investing is a bigger deal to them. In many ways, they want their values reflected in how they invest. And so just the passage of the last generation's wealth to this generation is causing more interest in that, but also the wealth creators are more interested in that. And that's going to have an impact. And I think that the leading Canadian institutions have thought a lot about that, and some of the leading US and European institutions, it's happening on the ultra-high net worth family side as well.
And it's not going to stop at ultra-high net worth. I think this mode of thinking, this more quantitative way to construct portfolios is becoming prevalent all the way from the largest sovereign wealth funds to the pension plans, to the endowments, to the family offices, but it's actually not going to stop there, because once this technology is available, and it's starting to become available to even the mass affluent and to the retail investors, I think this is actually fundamentally going to change how people think about their portfolios. Again, the power will be in their hands, and this is going to have a very deep and long-lasting impact on how asset managers respond to that.
Right.
Because the information asymmetry, which has existed for decades, is going to go away with this technology.
That's a really interesting point, Machado. I wonder if you could weigh in on this notion, and it seems like this holy grail, and I feel like every year at this conference we hear about it to some extent, if not retail, at least the mass affluent access to funds or asset classes or sub-asset classes that have largely been unavailable in the past. How much does that offset some of the outflows from institutions into hedge funds and other assets?
That's an interesting question. I don't numerically know the answer to the offset question, but certainly we see a vastly increased interest from the wealth channels and just even available for your basic garden variety 401k plan. And we spend a lot of time working with our distribution partners, working to educate the FAs that will be facing the public and dealing with some of the high net worth individuals about the different ways that they can access these types of strategies. I agree. I think we're fed back a lot of information from them about what this generation of new investors want, and we've structured some of our portfolios to make them more accessible and more user-friendly to some of those folks. We don't see an enormous amount of money on the retail side, as we call it, but what I do see is a big growing interest in it, and I also see the distribution channels really working with their individual retirees to say, look, you have something that looks like a 60-40 portfolio, you're running a very large concentrated bet, basically in US equity beta. It's going to hit a bump in the road that is going to be painful for you, and you really need to be thinking about different ways that you can access new content.
Yeah. So I want to go back to something you said that I sort of let sit there for a second and made a note to follow up on, which is we spend a lot of time thinking about U.S. equities, and we don't think as much about global equities, global flows of money. This is going to lead us, hopefully, for a few minutes into a conversation that will touch on geopolitics. But I wonder how you keep the discipline in your shop of saying, look, guys, we got to get beyond what the Dow is doing, what the NASDAQ is doing. How do you do that? And what do you see when you look beyond Wall Street?
So I think, very importantly, almost all of our clients are long-term investors. So I think they help us a lot in really staying focused on, not even 5 years, 10, 15 years out, what the returns are going to be. And the needs of a long-term investor are fundamentally different. And the needs of a pension fund, which is meeting liabilities, are also very different than people who are worried about the returns this year or next. And I think people don't necessarily appreciate that. So, for example, folks are always surprised that we have all this geopolitical risk out there right now, but the VIX is at an all-time low. Why can that be true? And the answer is very simple. If you're a large institutional investor with a 20-year time horizon, I can't think of one client that has gone back to their investment committee to redo their European asset allocation because we have a UK general election, a French election, and an Italian election coming up. This is the kind of long-term equity risk that they're meant to take, and they will be there through thick and thin. And tying it back to the retail point, actually most institutional investors, I would say, are more in cash right now than they've ever been. And the reason for that is that they are waiting for one of these jolts. We'll have a little bit of a market correction. The retail guys will run, and they will actually use that as a chance of putting more money to work. And I live in fear of retail investors getting into a lot of these deeply illiquid assets, which they don't understand, don't actually have the appetite to take that risk. And when the going gets tough, they'll get out at the bottom, and it will be bad for them, and it'll be bad for the market. But long-term investors actually benefit from these trends, and for the most part, our investors are staying the course through what is normal political risk in Europe and elsewhere in the world.
All right, so let's key off of that. Normal political risk? Is this the new normal for political risk? Because I, look at my Bloomberg terminal every day, and I look at the headlines, and I read the newspapers.
Yeah.
This seems a little scary and abnormal at times. What do you think, as an investor?
I've been investing 25 years. The word normal, I'm not even sure what it means. I'm really not sure what it means. Everyone says, when are we going back to normal?
Yeah.
I don't remember a normal year or two. It seems like we've had a variety of political risk. It's probably driven, it's driven more home now because we're having elections that are unusual globally. But I think this is the new normal. I mean, this is, you go across the globe and there's similar movements in countries where the citizens and the voters are asking to have more attention paid to the non-elites than the elites. And so it does seem to be the new normal wherever you go.
So how do you invest in that sort of world, Nobel?
Well, I think the markets have become more efficient. And that has to do with just the interconnectedness of the world, the amount of data that is being produced, which is just at a scale that is completely mind-boggling. And so what has happened over the last several decades is that each unit of data is worth less for a shorter period of time and is getting absorbed by the market faster. There's obviously an exponentially larger amount of ocean of data that's out there. But the outcome of that is that whenever an event happens, it effectively gets absorbed in the market, and so there's this appearance of calm and peace. And this is back to the distributions. The distributions are certainly not normal. What happens is that you end up with lower volatility. You end up with an environment where things effectively appear more peaceful until there is a real shock that nobody expected. And seemingly even the shocks that we saw last year, the market just sort of shrugged them off and moves on. And so I don't know what kind of shock it'll take to destabilize the markets, but when that happens, the dispersion of the returns, the volatility will be significantly more accentuated because in the end this piece will be shaken.
So Ron, what does a shock look like?
I'm going to come back to that an opportunity, Frank. I'm going to come back to that long-term piece for a moment. Given that we're long-term investors, where we invest and how we invest in various countries becomes important. And I'll tell you how we think about it. So, for example, if you're going to buy a piece of infrastructure in Chile, or if you're buying an airport in Europe somewhere, you better have a strong sense that, first of all, you're investing, because it's bricks and mortar. I mean, you cannot sell an electrical transmission system in Chile tomorrow morning like you can sell Apple stock. Right. So the liquidity issue is a very important issue. And so when we're investing, we have to look beyond the election cycle. And one of the questions we always ask ourselves beyond the election cycle is, if a new administration comes in, how likely is that administration, how likely are they to be able to change the way the country fundamentally runs? Are there checks and balances? Let's take an example closer here to home. We've seen a number of things that wanted to get changed fairly rapidly. And we saw whether it's the judiciary or the press or number of people come along and provide the appropriate checks and balances so things don't get out of whack. Those countries that when a new administration is elected and comes in can turn the world upside down, we have to really, we have to discount these kinds of risks. We're investing for the long haul, and we're investing in assets that'll be there for quite some time. So, for example, in Europe, as I think I mentioned earlier, we've got 5 airports. So is the euro going to break up? 3 of those airports happen to be in the UK.
Right.
So what does Brexit mean for that? We have to be able to assess these risks above and beyond the current administration and the current thinking. Now, are we fantastic at that crystal ball? Not necessarily, but have we got it more right than wrong? And the answer is yes, we have. And therefore, I think I'll take that edge given the results that we get out of that. That's how we tend to approach the longer haul and the geopolitical risk. We don't jump in and out all the time. And it's absolutely true. We've not gone and changed our portfolio dramatically at all. We are just much more aware of where we need to be and where we should not be for sure.
And so as an asset, but I'm going to let you talk, don't worry. But I just want to follow up on something you said, which is as an asset owner in Europe, surely you have to pay close attention to French elections, German elections, snap elections in a way that you wouldn't have before, right?
We watch them closely. But here's a good case in point. In France, for example, we own a funeral business. It happens to be 40 or 45% of the entire country's funeral capability. And from our perspective, we actually believe that whether it's Le Pen, whether they're in Europe or out of Europe, or whether there's bobbing and weaving along the way, fundamentally, I think people will still be dying 15 years from now, 20 years from now, and so we're there. So it makes a lot of sense. So we do think about the long term.
I don't even know how to react to that. It's amazing.
You found the policy-proof investment right there.
Oh, boy. You were saying?
On a cheerier note, I wanted to pick up on Ron's comment that, when we think about political risk, in many ways, long-term investors think about opportunity.
Yeah.
Our biggest challenge right now is that markets are pretty fully priced around the world. You
Right.
look out there, if you have a few shekels you'd like to put to work, it's hard to figure out how you would do that on an attractive risk-return basis. And one of the reasons many of our clients have extra cash is that they would like an opportunity to get in at a lower cost. So if we did have a big price into something, I think you would find people moving into that.
Right.
And we have an enormous amount of liquidity in the world between the pension funds, the demographics we've been talking about. That is going to provide a real buffer to how far markets are going to fall. This money has to be invested somewhere. Mm-hmm. And I think people actually do look at geopolitical risk as an opportunity to get in a better entry point.
But we talk about what's the shock going to be, and I agree with exactly what you're saying. I think the shock's going to be when people look up in 10 years and they didn't get their 7 or 8% returns. I mean, seriously.
They should stop expecting that.
Yeah. I mean, we see global equities returning, our projection is 6% over the next decade. It'll be wrong.
Ours
but
is 5.
Yeah,
so.
It'll be probably in the neighborhood.
Yeah.
Bonds, too. A 60-40 portfolio, that's 4%. Where's the other 3 going to come from? And that has real societal impact. It really does. And this is what drives us. Every 100 basis points of value we can add, it's medical research, it's scholarships, it's paying pensions. But that also means every 100 basis points they don't get is less medical research,
Right.
less scholarships, less people getting their pensions. I really fear that's going to be the shock in 5 or 10 years.
So we have just a few minutes left, but I want to make sure that we talk about a little bit of what's going on here domestically. Many people here yesterday listened to Secretary Minuchin, Secretary Ross, and a number of people, that this administration has said a lot over the last 104 days, I guess we are now. What are you seeing, what are each of you seeing that could either on the margins or fundamentally alter the asset management business here in the United States? What is looming out there? And technology, I would imagine, must play into this, especially as you think about regulation different, the possible elimination of Dodd-Frank. Bloomberg, I will say, had an interview with the president yesterday where he said he wants to break up the big banks. I mean, there could be, at least theoretically, some shifts that really do redefine the banking and investment system here in the United States. How do you manage that?
I think all of the things that you mentioned are relevant. The regulation, all of those trends are important. I think what is stronger and first order compared to all of those is actually just technology, is just the nature of the markets, is the explosion of data that has changed. Well, it's revolutionized every industry out there, and there's no reason why investment management should escape that. And I think that is the force that is far greater, far more powerful than any regulation or any other thing that is going to affect this industry over the next decade. That is fundamentally changing the kind of talent that you need. That's fundamentally changing the way people approach the business. That is, I think, what people have to reason with over the next decade.
So as an investor, what do you make of it so far?
So I do think that technology will play a very important role. We manage over $100 billion in quantitative strategies, and we take in literally 10,000 signals in the course of being able to do that. And our models take that information and turn it into what's really important for investing. But I would say that it's going to be a lot harder to do this broadly in other asset classes outside of equities than we give it credit for. And part of the reason for that is that many of our clients are finding they're in this kind of much data, little wisdom category where there is this explosion of data, but actually much of it is irrelevant or not actually related, or us in engineering talk about it, it's just noise. And the ability to actually translate it into clear signals actually requires real human intelligence together with technology. And so we would say that this is not a question of technology replacing investment acumen. Mm-hmm. It's going to be much more a question of technology and data supporting investment acumen, and that is where the secret sauce will be. But it's going to be much harder to do than many people, I think, at the moment are expecting.
And what about from a regulatory environment? I mean, what do you see that's out there that, because there have been a number of proposals floated that, could change the way money is managed in this country. Do you worry about that? Are you excited about it? What's your reaction?
It could. I would not have had regulation really on the fundamental long term. If you ask me 10 years, what's changing the industry? Much more important for me is actually a comment that Ron made about the need for strategic partners. So most of our large clients are saying, we want to do business with fewer firms and do more with them. But by the way, the bar, if you want to be one of those partners, is going up dramatically. You need to deliver global capabilities, you need to deliver technology. And so we are going to see a real shift to fewer firms generating more and more of the assets. You can see that over the last 10 years. It's absolutely happened. But I think with the advent of the importance of technology and brand, which are all expensive fixed cost in many ways, you are simply going to see the larger firms that do this well and our strategic partners pulling away from the rest of the pack.
All right, Michelle, both these guys have blown off my question about regulation, so I'm going to ask you.
I'm going to turn it right back to technology again and partnering up.
Yeah.
Well, I mean, I actually tend to agree. I don't think that will be the most transformative thing that will happen in our business. I do think it will absolutely affect our business, and I think it will, hopefully it will make, the past 10 years have made the folks that are managing money aware of the way they need to behave and the way they will be, accepted as an institutional partner. But at the same time, you also need the ability to hire the right people, have the right budget, have the flexibility to actually execute your strategies. So hopefully we'll find that happy medium there with some of the deregulation that's being talked about, and we'll still be left with institutional quality behind. But I do agree that is that my cue to stop talking? No, that's somebody's phone.
No, somebody's phone. So
Okay.
it's just getting a call. It's fine.
I agree with technology being the way forward. I also agree that it's a combination of technology and people.
Yeah.
We too hear the same thing from our clients and are working towards the same attributes, which are partnering up very closely with folks that we can do a lot of business with. But one of the other things that we're doing is thinking about that talent. How do we bring in the appropriate people into our firm to not only manage the new technology, understand the new data, work with that in the markets as a whole, but also to take that and translate it for some of the clients that we service. And to that end, we've been working very closely with a number of universities to foster the talent, foster the research. We have a cooperation with Oxford in the UK. We have a number of different training programs and internship programs that we're bringing in. We're competing across the board for talent, as you were indicating earlier. So it's really important to, I think about what will be transformational and how you have to build your business to be there and be ready for it when it happens.
Yeah, I just want to add two things. One on the comment of people focus on global equities. I mean, equities is clearly, certainly U.S. equities is the most liquid, the most transparent asset class. But every year, more asset classes, more markets lend themselves to that. Today we trade in over 30 equity markets. We trade in dozens of futures and FX markets, in various derivative markets. And so this trend is affecting everything. Clearly there are some markets and some places which aren't liquid enough, which aren't where the regulation is not, there's not a level playing field, there's not enough data, and so on and so forth. There's certainly some limits, but one by one, each one of these markets is lending themselves to algorithmic approaches. And then the whole distinction about are people important, is technology important? Well, of course people are important. People have an important role to play, but the talent will evolve. It's not simply the moment you've already got it wrong if you start thinking about technology supporting people. It is a different kind of talent. It's a different sort of mindset that it takes to be a technology company, to be able to solve these problems in an algorithmic way. I mean, is Google an advertising company? Or is Amazon a retailing company? So fundamentally, how you approach a problem has to evolve, and it doesn't matter if you're an asset manager or an asset allocator. In this world that we live in, it's going to fundamentally change how we think about this. I mean, statistics that we often quote, which shocks people, is 63% of Two Sigma's staff does not have a background in finance.
Wow.
2/3 of our people are in R&D. So that's the sort of DNA, that's the sort of culture that I think it takes to really approach this from a completely fresh perspective.
Regulation?
Yeah. I'm going to ask this regulation question until somebody answers.
I'm going to answer it. Good investors are humble and they have humility, and they're not overconfident on things they can't predict or know. Regulation, changes to regulation, the things that are being talked about are very complicated. They're multivariate, be very hard to predict. The things we know that it'll cause some opportunities and it'll cause some parts of the market to become more efficient probably, or opportunities to go away, and we'll just have to evolve when it happens.
Right. So Ron, the last sort of question on this topic is this notion, because you're Canadian, I'm going to ask you this. NAFTA may go away or be largely renegotiated. I mean, we had the Secretary of Commerce talk about that yesterday. We've had the President talk about it. The President has talked to your Prime Minister. I mean, how does global trade, or some pretty fundamental changes in global trade that are being talked about, does that affect your investment outlook at all?
No. Fundamentally, I think we're always looking for these checks and balances. And whether it's regulation in the asset management business, I actually think the asset management business in the US is big enough, has a loud enough voice, generates enough money with enough prominent people that if they really tried to do something ridiculous to it, there'll be a counter force that will deal with it. I think the same is true in NAFTA, for example. When they start getting into the negotiations, the initial indications were blow it up.
Right.
I think cooler heads prevailed and recognized that there's a very, very strong self-interest in the U.S. in not blowing it up, given that when you build a car, parts go back and forth across the border 7 times for every single part that's worked on, whether it's with Mexico or Canada. So I think the check and balance there is the self-interest of what is going to, or if it hasn't already, it will ultimately become clear that that's going to be the check and balance to just how far they will push it. But it will be a negotiation, but I doubt at the end of the day we're going to end up with something that is completely radically different from where we are today.
Got it. All right, we have just a couple minutes left, so I want to throw a curveball at these guys, and basically, for the benefit of the audience, ask them each to give you the one thing that they want you to remember from our discussion today. And I'm going to start with Nobel.
All right.
Most important thought. Could be one of yours, could be somebody else's.
Most important thought. I think that the mindset that we are going to have to approach problems in the future is going to have to change dramatically. We're going to have to take a much more scientific approach, data-driven approach to solve all kinds of problems. And investment management, asset allocation are no different than that.
Okay, I should say you can't just say, I agree with something somebody else said. You have to have your original thought. You're next.
Glad I got to go first.
Yeah.
So I continue to hope that the main message that people will take away from today is that the asset management business is very large and is made up of a lot of long-term investors and a lot of different asset classes. And the very narrow focus of the media and others on the U.S. equity markets is simply overblown and lacks the context. And those of us that invest for 20 years really are looking out at a whole set of illiquid assets, and we're doing so with a real eye toward crises can be opportunities, not just that the world is going to somehow come to an end. And I think that's a very, hopefully, reassuring perspective for people to take away.
Michelle?
I think that the word that I heard up here repeatedly was partnership, and I think that I said before that we've taken a very pedantic look at asset management over time. And this is a very broad topic that we're talking about. It incorporates the technology, it incorporates the private investment, it incorporates the talent. And to Ron's point earlier, it's very seldom that one individual organization can do all of that. So the idea that you can find people that you can work together, be very fluid and open-minded and creative and entrepreneurial in your thinking about the way that you want to approach the space and how you want to extract return, the partnership is the key thing to me.
Druley?
The next 10 years, it's going to be tough to generate the returns that everyone out there is targeting, whether it's 6, 7, 8%. And we're talking all up here, we're talking about evolution, thinking creatively, adapting, and we should. I would encourage everyone that as the asset owners move that direction to try to generate better than 4 or 5 to get to 6 or 7, they really think about the talent they need to have in place and the structure they need to have in place to succeed. Or I'm afraid that 10 years from now, we'll look back and societally we'll have suboptimal outcomes.
Ron Mock, final word.
Our organizations, in order to be sustainable, have to adapt and adjust. And for us, the core is investing in the talent, and then investing in the talent. And it's not a cost, it's an investment. That's the only way you're going to keep moving forward and be sustainable.
Great. Ron Mock, Michelle McCloskey, David Hunt, Nobel Gulati, David Druley, thank you very much for joining me. Thank you very much for your attention.
Thank you all for your time.